So we come into another panel session now, and I'd like to invite Mark Tyler to the stage, who's going to be anchoring this one. Michael Taylor, who's going to be anchoring this. Mark Tyler is one of the panelists. Michael, please come up, and we can run through very quick introductions and take it from there.
Okay. Please come and sit. I think, given that there's five of us, does it work? Yes. Okay. Good afternoon, ladies and gentlemen. I hope we'll have an interesting discussion. We've certainly got a great panel. My name is Michael Taylor. I'm a lawyer with Gowling WLG. I'm the moderator of this session. And before I introduce you to the other members of the panel, can I just say a few words about our subject, which is financing world-class mining projects of the future. Now, if I look to the past, if we were seeking to raise finance to develop a mine, there was one basic source for that, which was banks. A large number of banks were active in the market, competing with one another, development banks as well as commercial banks, many of them with specialist mining teams. But in the wake of the financial crisis, I think we've seen quite a significant tightening of the bank market. But at the same time, we've seen the emergence of a new class of lender, namely the investment fund, specializing in mining finance. We've also seen a very significant growth in alternative forms of finance, such as royalties and streaming. Now, I think the panel we've got here today are particularly well qualified to discuss these recent developments. So, without more ado, let me introduce the members of the panel. And if I start from my far right, Julian Treger is CEO and Executive Director of Anglo-Pacific Group. They are one of the largest providers of royalty finance, and I believe they're the only company listed on the London Stock Exchange which is focused on mining royalties. Then we have Michael Barton, who's portfolio manager at Orion Mine Finance, which is a global alternative investment management firm specializing in the mining and metals sector. And I think they recently closed the first lithium streaming deal. Yeah. Good. I'm glad I got that right. And then Pim Kalisvaart, who is portfolio manager at Hawke's Point Capital, an asset management company, again, focused on mining finance. And they're backed by Tetragon, which has over 15 billion of assets under management. And finally, Mark Tyler, London representative of Auramet International, which is a global metals company active in physical metals trading, but also providing a wide range of services to customers. For example, price hedging, advisory services, and debt finance. So, shall we move on to our first question, which is how available is mine finance to the junior sector at present, and what size of project can get funding? So can I start with Julian?
Sure. Thank you, Michael. Well, I think this, all cycles are different, and this is no exception to that rule. And what's different mainly about this cycle, I think, certainly on the equity side, is the rise of indexation and ETFs, which has meant that money hasn't flowed into the smaller cap specialist mining funds in the way they did in the last cycle. Money is flowing into the mega cap funds, which are in turn investing in the likes of Glencore and Anglo and Rio. The problem for the sector is that those large companies have been told by their shareholders still to practice fiscal discipline and to pay large dividends and not to fritter their money in new projects and investments. And so they are not building the mines which are necessary for the cycle. The problem, on the other hand, is that there is a lot of people who want to build new mines, and we've seen with the commodity prices moving up, a lot of projects which are getting ready to be developed. But the traditional sources of funding for those funds, which are the specialist miners, as I say, have no money. There was no money last year in Toronto. There's not much money here this year in London. And so we are facing a situation where those who have money don't want to do anything, and those who want to do things cannot really access the money. The specialist fund managers who understand how to pick project A from project B. So I think that has meant a rather constrained environment for traditional equity in financing, and that has led to the emergence of alternative financing sources, as we've discussed. I think as well, net, there hasn't been big inflows into private equity, and there are some funds like Orion which have had tremendous successes in growing, but then there have been others like Mick Davis and others who have found it challenging to raise their second funds, and a lot of those private equity funds are trying to do deal-by-deal investing at this stage. And then if we turn to the banking side, a lot of the banks were burnt in the last cycle, and so there isn't that much banking finance either. And that really leads into these alternative sources, of which royalties and the sort of Orions and Hawk Capital are examples. Is that a helpful background?
Yes. Pim, would you like to add a comment?
Yeah, no, I concur with what Julian says. I would nuance it somewhat, that I do think there's equity available for projects. I think what equity type investors would want to see is a slight change in some of the behaviors that we have seen in the past, and people living up to expectations and crucially to promises being made. And I think that the difference in what Julian points out and where I'm coming from is perhaps captured in the title. You're talking about world-class projects. Now, in my book, world-class projects are the type of projects that a BHP would want to own, and they're typically extremely large, low cost, long life, and all the rest of it. I think for that type of project, which has $1 billion plus capex, funding is still very constrained for all the reasons that were pointed out earlier. For smaller projects that maybe have a capex of, say, a couple of $100 million, I think there is a very healthy market both on the equity side as well as on the debt side that is willing to provide capital to those projects to put them into development and ultimately into production. And I think if people focus on that and right-size their project to the degree that they can, and focus at progressing that, then I think they'll have a very good hearing from the alternative asset management community, in part represented here, but all around the world.
Michael, do you have a comment?
Yeah, I think I broadly agree with most of those comments. I think size is important. I think if you do go beyond, let's just use a round number of $1 billion, it starts to get very challenging if you're a junior trying to finance something over $1 billion. Even as you start approaching that, you mentioned we were involved in this lithium deal the other day. That's getting on for $1 billion of capex, and it's a wonderful project, but they've been working incredibly hard for an incredibly long time to get there. So it is tough. I think it is easier at that. If you're in a mainstream commodity, not an obscure commodity, and not a hot commodity like cobalt or something. If you're in a sort of a mainstream commodity, a couple of $100 million is doable, and there are sources. I mean, it's what we do, but I mean, we would be the sort of the rise, the advent of Orion is really driven by that other people stepping out from the sector, and we shouldn't pretend it's just because we're wonderful at what we do. It's not. It's because there's an opportunity in the marketplace for us to step into and fill that void. So it's clearly not as available as it once was, because that's what's allowed the likes of us and other similar outfits to develop.
Well, before we move on, Mark, do you have anything just to add on this one?
Yeah, I don't think I have much to add on the equity side of things, but I will say sort of on the debt financing side, I believe that there is finance available from a very large scale, as Mike said, probably not over $1 billion. I think that would be a bit of a tall order, but all the way down through to fairly small scale projects can be financed on a debt basis. I think what you can't do anymore is get cheap leverage where financiers are willing to take on quite considerable risk for very low price and thereby increase the returns to equity holders. I think you're getting debt priced at sort of more realistic levels, and so the old idea of cranking up your returns by getting in a lot of cheap debt just doesn't work anymore. Banks even will ask for conditions that reduce their risk, even though they may not push their pricing up.
Well, moving to the next question, which is how should mining companies maintain their share price during the transition to production? Now, I think that's a very difficult question, and I'm pleased that Michael has offered to tackle it.
I did say I had any answers. It's obviously a perennial problem, and I think it's particularly actually bad at the moment. Once upon a time, with this sort of retreat of a lot of the equity investors, because it's the equity investors that support those share prices without stating the obvious. But with the retreat of the equity investors that we've seen, really, in particular over the last 12 months, it's actually got worse. There's only a handful of funds out there globally who are really active nowadays. Most of them actually here in London. You don't have that big Toronto market that you used to have. Or Australia is a bit of a special case. So you've got your big funds, and even in things like gold, which have got their focused investors in gold. Even there, you see companies putting out good news releases over the last few weeks. Seen several examples, and the share price has actually done nothing to tail off. I'm involved in a company called Dalradian, for example, that I'm on the board of. They put out a 42% increase to their resource whilst they're waiting to get their permit in. Share price rallied like 7% and then came right back down again after a day. So it's very difficult, and it's particularly bad at the moment. I think what you can do is people can think about it. So if they have the available funds, they can continue drilling. If you haven't sort of totally finished your deposit, you can keep drilling, you can keep optimizing. You don't need to stop just because you're building something. And then obviously the other argument that some people have is you can add a producing asset. I mean, that's the other angle that people try. But, you've got to question that logic sometimes. It works sometimes doesn't.
Can I ask Pim, because I think Hawke's Point is also an equity investor. So what's your thought on this issue of how does a junior mining company maintain its share price?
Yeah, we're investing out of the balance sheet of our parent company, so we're not the type of investor that every day or month that goes by have a look at the share price. We're much more focused at what in the long term the company can achieve, and as far as we're concerned, as long as the company is on track on those milestones, we will continue to be a supportive shareholder. What I would put out there is that if you as a company are having discussions with potential financiers, make sure that if future share price performance is a concern for you, that you right-size the funding as well. I talked about potentially right-sizing a fund, a capital outlay, but if you're talking with someone that is wanting to invest capital for you, it might be painful for you to have that discussion, but make sure that you get some and then a lot more than what you think you'll need, simply to bridge a period if a share price performance isn't what you want, that you're not up against it and having your last million and needing to go and cap in hand and round and try to find more money. Make sure that you have, to the extent you can, a supportive shareholder base that can see through that, and that gives you enough capital to go through those periods of maybe less news flow, whilst you're working on the real value creation. Because as far as, as soon as you start construction, between that and the actual commissioning, by the very nature of it, not much is going to happen. And if you have enough capital and working capital to sustain, maybe some slight cost overruns, you're in a much better position to weather any of those pressures on your share price than you otherwise would be.
Julian, can you add anything?
Well, I think the stock market is not providing the services historically that they used to companies. So I think unless you're a large company or a company which is in a hot sector like lithium or cobalt, in which case you can mine the market successfully, I think you're better off being private because you're not going to get the following. I mean, the market doesn't have the patience for the interim parts of the Lassonde curve anymore, and it's very difficult if you're in a 3-year construction period and then you have the ramp up to sustain interest. I think if you're in lithium or cobalt and other hot areas, and by the way, what I didn't talk about before is if you are in those areas, you can probably bypass the traditional mining finance network and go direct to end users, and there does seem to be more of the financing coming from Chinese or automobile battery manufacturers for that, which is an interesting development. But unless you're in those areas, if you're subscale, it's very difficult to maintain interest of investors.
But I mean, it's interesting that the company concerned may have been quite successful on the stock market in its exploration phase, but you're saying that actually it becomes more difficult to maintain the share price as you go into the transition.
Well, I think on the exploration phase, you can constantly feed the market with new drilling results and, appointment of X consultant and Y, contractor. But once you're actually into the building phase, it's very difficult to make those announcements, and you have to go somewhat, under the radar for a year or two. And the stock market is addicted to short-term price announcements and regular jolts to provide momentum.
I think that's true. I think when you're going through the financing phase, you're actually speaking to the big institutional investors who sit there and they're sticky and they understand the process. Meanwhile, you're having your share price traded by a bunch of retail investors, and possibly the right way to do it is to feed them what they want. And you have a small exploration project running on the side that you can feed a ton of news out on.
Thank you. Our next two questions are really the other side of the same coin. The one is, are banks becoming more confident in the mining industry? And then the other one is, has the presence of non-bank project financiers changed the debt markets? So there's really two questions there, which are very much linked. What is the attitude at the moment of the banks? How keen are they? And then what is the effect of the non-bank financiers? And I think perhaps we can start with Mark on that, particularly commenting, I think, about you probably have the best knowledge of any of us in relation to the appetite of banks for this market.
Yeah, I think we've just come through it. We've just finished an advisory process where we advised the company, Victoria, on a deal that switched from a bank deal to a deal where Mike's company provided most of the finance together with a royalty company. And I think the difference was that the banks, they're confident, but they're more confident in demanding things that possibly are not that palatable to issuers. And I think, as I said earlier, I think what they're looking for is to reduce their risk. There's a smaller number of banks available. They're much more picky about what they do, and they tend to be much more demanding about their terms and conditions, even though the pricing, the coupon may be a little different. And it's made an opportunity for non-bank investors who actually understand the industry better possibly than the banks do to come into the market and to mop up the available opportunities, the good ones.
Michael, what's your thoughts?
I would agree with Mark broadly there in that the banks are trickling back in. Standard Chartered have made a big move by appointing somebody recently to really re-energize that practice. Part of that role, I know, is going to be returning to lending. You've got some people who've stuck it out, SocGen being probably the most notable one. But they're picking their opportunities. So they're lending to the majors to develop their projects, but they're not necessarily really trying to compete with us. Put it that way. In fact, quite the reverse in many respects. We see cooperation with them. And I guess the other thing, just picking up what Mark was saying, is the pricing of the banks is now very, very similar to where we're pricing. What we can do in almost every situation is illustrate to, there's a perception that funding like ours is more expensive than traditional bank financing, but it's not actually necessarily true. We can illustrate in most scenarios for a good quality project that lots of people want to finance, i.e. one we're going to, compete hard for. In that situation, I could almost always develop an illustration to prove that we're as cheap as the banks are. And obviously we're far more flexible. I think on the advent of non-bank financing, I think what we've been able to do, and others like us, is we've been able to, rather than just offering a standard product that says, you take this is our bank, this is how we do it, take it or leave it. What we've been able to do is really be a bit more creative and adapt the financing to the situation. So we do not have a standard form of financing, and this not just us, our peers are the same. We tailor every single investment that we make very carefully to that situation. And it takes longer, but it fits the purpose far more. And I think that's the key advent of this. So even though the banks have stepped back, you do have a broader range and type of financing. So you can, you can of course just do debt and equity, but nearly every financing now seems to have some other component associated with it. So people need to stop being negative on a royalty or a stream or whatever it may be, and actually just use it as part of the mix. Some projects lend themselves well to having a royalty on them, others less so. Others need to be more equity heavy, others need to be more debt heavy. So I think that it makes it more complicated, and it means that good advisors are needed, but it is available.
Julian.
Sorry, Michael, to interrupt. And I think the other thing that we should interject here is that people often don't take into account the value of having a quick decision or quick financing done, and saving on legal fees, just by getting the deal done very quickly. But I mean, the terms actually of getting something done quickly is really attractive when you look at the non-bank guys.
Julian, would you like to comment, particularly in relation to the alternative forms of financing?
I think the alternative forms of financing are on the rise because of relative lack of bank debt, and also because, as Mike was saying, the cost of capital is rising because of the supply-demand imbalance in the sector, and therefore making it all more palatable. But we are absolutely tailoring each one of our royalties. Each one is individually negotiated, and they're increasingly having more bells and whistles to allow, for instance, buyback options, during the life of the royalty, to allow the issuer, if they have a windfall, to remove that and repay it. So I think the market's becoming all the more sophisticated, and we are and have seen over the past couple of years royalties becoming much more mainstream in terms of being a financing vehicle, and I think we'll see more of that going forward in M&A transactions, because the wave of M&A is going to occur in the next couple of years.
There's a related question, which I think I'd like to pose, which is this. Particularly in emerging markets, one often sees the presence of export credit agencies and development banks. And they obviously have got a lot of experience working with traditional bank lenders. I'd just be interested in the panel's thoughts as to how alternative debt providers, and indeed alternative forms of finance, can fit in with the development banks and the ECAs.
Well, I think, the recent experience of was it First Quantum, was quite illustrative. It was a particular circumstance where they'd already spent a lot of money on the project, but they had spent years messing around with these agencies and not really getting anywhere. And eventually they issued a bond, and that process came to an end. And everybody was quite surprised, because the market was expecting the ECAs to come forward with that funding. And I think it was a sign of the slowness of those more bureaucratic institutions versus the rapidity of the bond sector in terms of wanting to an ability to finance something
So
significant.
you're viewing these newer forms of finance as really an alternative to the ECA or the Development Bank.
In certain circumstances, partly because of Mark's point about speed of decision.
Look, and I have to say to you, Mike, we've seen a couple of transactions where, in fact, the development banks weren't interested, but alternative financiers were quite willing to come into places, for instance, like the DRC, and take naked political risk. But I think it's with the understanding that the underlying project is something that's world class and really attractive. So you're not relying on cheap support from a government.
I mean, we actually have a good relationship with the IFC, AFC, EBRD, and have done deals with all of them. So it doesn't have to be an alternative either. What we've been able to do is move quicker in certain situations, and almost, I don't use the word bridge, but complete a deal and then let them go through their processes and come there, because they do. It takes a long time with them, but you get past a certain stage and you do have good confidence that they are going to get there. It just takes an awful long time. So we've done deals, like I say, where we brought the IFC in afterwards, and the AFC as well. So.
Yeah, and as maybe a more predominant equity holder, I'd encourage anyone to take these comments into account and start conversations early, so that you have maximum optionality, and then. Ideally, it's gotten a lot more complex. The plain vanilla debt equity, like we saw last decade, that is no longer there, or not for everyone. This more complex world with more complex financial products probably requires a specialized skill set. So again, not only start earlier on exploring the various options, but also recognize what you know as a management team, and certainly what you do not know, and take in advice, because understanding the true cost of capital and the true pros and cons of some of those instruments and funding options that you have, you could probably do with someone that does that on a daily basis, more so now than, like I said, a decade ago. So I think the point being, get some advice on this and start early, so that by the time you do need it, all options are open to you, and you didn't close an option simply because of inertia, by lack of a better word. Because it's absolutely true, some of these organizations with a perceived lower cost of capital take more time, but let that not disqualify them. Make sure you bring them in so early that they might get to the finish line in time, and they might hurry up a little bit once they see someone else coming in any event.
Just on Pim's point as well, it definitely start early, but you can also come and speak to the likes of us early. It's our job. It's not, it's not. It is our job to sort of be engaging early in a process and giving an idea of the options that are available, even though that may be 3 years out from actually doing something. That's it's what we're supposed to be doing. It's not. We have to be having those conversations.
Yeah, I mean, I think one of the great benefits, by the way, of those sort of semi-official institutions is providing you with more insurance in difficult jurisdictions, and that is something very valuable, and not to be, underplayed. So I do think that best probably to get quick decisions and initial bridge financing, but ultimately you want to go to the lower cost of capital that provides you with some political insurance.
Now, we've only a little bit of time left, but I think it might be an idea. I'd very much like to throw this open to you all. I think we've time to answer one, perhaps two questions. So can I invite questions, please?
Are South Africa and Zimbabwe, as they stand at the moment, difficult places to invest in, from your perspective? Have things changed in Zimbabwe, really?
I mean, South Africa, I'm going on a due diligence exercise next week to South Africa, so no, but selectively. Zimbabwe, for us, would still be too far today, but I believe that could change relatively soon. If these elections take place and sanctions get lifted, then, I'm not saying we'll be rushing in, but it can change quite quickly. So a year ago, South Africa would have been tough for us.
Okay, the gentleman here.
be possible to tell us roughly what's the minimum and the maximum that you'll structure deals for? And would this be equity and debt, if you can tell us one by one?
You mean in terms of quantum in dollars or the price of that?
In terms of how much you're lending or
Yeah. Well, yeah, I think, I mean, from a royalty perspective, it really sort of depends on what stage the business is in terms of development. If it's in an early development stage, then we would be interested in doing 5 to 15. But if it's in production, it's from 25 up to several $100 million.
We like to say our minimum investment size is 100, and we push that up US dollars, and we push that to $500 million plus. With sometimes we bring some of our investors follow along with us. So I think the biggest single ticket we've written sort of 600. But we also are able to do what we term intermediate transactions, which are more in that 20-25 million range as well, for earlier stage assets to work with a company from like a step before they're ready to build.
In our case, our sweet spot would be 20 to 30 million US dollars, with significant upside potential beyond that for something that we really like and want to continue supporting. Much less than that starts to be difficult for us. So call that the bottom end as well.
Yeah, look, we don't provide equity, but for our debt transactions, we'll go as low as $1 million if necessary, if it's properly structured. But we'll max out at about 30. We won't do more than $30 million. I don't think we're unique. I think there are other people who will do limited financing, and as Mike points out, you can go beyond that as well.
That's purely debt.
I wish we could take another question, but I'm afraid our time is up. So thank you very much for your attention, and we must leave you.